Okay. And we're off. So if we think back to the circular flow, we've mentioned it a number of times this semester, and hopefully something that you'll carry with you for the rest of your life, is at least the broad strokes of our current tax system and how it fits into the marketplace. So we have the output market and the resource market, our two primary markets that we look at as we try to get scarce resources to their highest and best use. And we have a government that's necessary for public goods, the establishment of law, the protection of property rights, a number of different functions that the government plays, and they need funds to be able to do those activities. And so we collect taxes in a couple spots. That leaves us two spots really to collect tax from. From resources, so on income, or at the cash register, the sales tax. And currently we collect it from both spots. So we've got models that we've been developing the entire semester that can look at the implications from those taxes. And we're going to continue to do that in chapter 13 as well. But today I thought we'd just jump right into what this Fairtax thought is all about. And they propose to shift all taxes into sales taxes. Collect everything we need at the cash register. So they propose a 23% tax. Would that be a little sticker shock for you if you go to the cash register instead of the normal, well, in Kansas nearly 9%, in Iowa it was about 7%. Go to the cash register and you buy $100 worth of stuff, and what are they going to ask for? How much money? 23 bucks more. So $100 price tags, go up to the cash register, that'll be $123, sir. Ooh, that kind of hurts, right? But you can't think of it all that way. So what's the other part of that thought process that you need to work through? You don't have to pay tax on that income. So when you earn a $1,000 paycheck, currently, how much does your check actually read? If you made $1,000 worth of money, what does that check say? Something greater or something less? Something less, right? Okay, so we got that withholdings. So maybe your check is for $800 if you're roughly a 20% tax rate, or how much withholdings. We settle up with the IRS at the end of the year on April 15th, but we kind of systematically withhold an amount that would hopefully cover your obligation at when we come to terms on April 15th. So we can't forget that. And that's what's hard to grapple with this, is that if we think about our household and our business, there's our little smokestack coming up, right? So we got the cash register. So our green flows in the economy are C, our big C plus I plus G plus X, our money going into the cash register. And then our wages and salaries are coming this direction from the paycheck that we earned. And so our current system would say that the company is spending $1,000, but we're going to have some amount of funds flowing back into the government to cover the income tax, leaving our consumer with $800 to spend. They bring that $800 to the store of their choice, and so they bring their $800. Well, and let's just leave it $1,000. Those numbers don't have to match up, but you get the concept. Keep this separate just to keep some numbers flowing here. So they bring $1,000 to the cash register, and then there's a sales tax maybe of 7%. Oh wait, we said 9% for Iowa, or for Kansas rather. And so we got 90 bucks flowing into the White House here in the middle, the government. Okay, so what if we got rid of that income tax altogether? And we said, no more collecting there. Let's just make this 23%. That's the gist of it. The system is set up to be budget neutral. What that means is that the people who have put this together, which involved economists, by the way, one of which was Wayne Angel, I learned later was an early founder, proponent of this Fairtax idea. That 23% has been estimated to equal the current amount of tax that's being collected as is. So we call that budget neutral. Budget neutral. And the 23% fair tax, the money being collected at the cash register, is equal to the current status quo, which is a mix of sales tax and income tax. And then there's a number of taxes we'll talk about in a bit that we haven't even mentioned yet. All right, well, that sounds interesting. What do you see as some implications so far? If we were just to flip the switch, tell me about incentives. Talk to me about, economists are always interested about incentives. By changing the tax system in such a way that we're still collecting the same amount of money, what's happened with the incentives now for you as one of these little households over here? What's changed? Michael? Okay, you got more cash in your pocket for spending. Okay, but that cash in your pocket, once it gets spent, gets going the same direction, and if it's budget neutral, it's on average the same amount of money potentially. Okay, so that's true. You got more cash in your hand to spend. More willing to work. Okay, I like that. Let me put Michael's down here too, though. You got more cash to spend. I guess before I do that, Michael, let me push you a little bit harder. We talked about marginal propensity to consume, but that was tied into something else. If you had more income, more cash, right, because you're saying income, you also have more income to save. So you're doing both, remember. So spend is a possibility and save is a possibility. So let's put cash as far as disposable income. To tie this back into the concepts we did before, disposable income is equal to your income minus your tax liability, your income tax liability, to be more specific. We get rid of the income tax. Your income is your disposable income, which allows you potentially more opportunity to consume or save. Okay, back to Taylor's comment. What did you say, Taylor?
More willing to work.
More willing to work. So, more willing to work. Why do you say that?
Because you feel like you're getting paid for everything you're doing.
Okay, so the bottom line is you're going to end up having that full. You work 10 hours, you get paid $10 an hour. You're in theory making $100. When you collect your paycheck, you actually have $100, right? So there's kind of an incentive to work. So more incentive to work. At the margin, you're getting a little bit more there. Okay? Other implications.
What about the states who don't normally have a sales tax? Like,
Okay. So the way they've got this set up currently is that the states would still choose to do their own thing. And so those states could do an income tax on their own. They think that that would be unlikely, that they would maintain an income tax, because there's a lot of ease of use that comes along where you have to do it for the feds, and then your state income tax kind of falls right into place. So they think that it would be likely that states would all adopt individually. So we're sticking to the federal here, by the way, with the 23%. And so if the states tacked on another 4%, 5%, 9%, your actual cash register amount would be even higher. So this is strictly federal, but good comment.
I was kind of thinking that people are probably not going to focus on, oh, I have more money. They're probably going to focus on, oh, wow, I have to spend more money at the cash register. So I was kind of thinking about that. Maybe they'll tend to be more thrifty with their money.
Okay, all right. So now the burden of the tax comes on consumption. Now, I need to push you a little bit harder on this. When you save your money, why did you save? To spend it later. Okay, and what was the benefit of deferring consumption to a later time period? If you saved $100, what were you getting in return? Interest. When you earn interest, guess what that is according to the IRS? Income. You got it. So now you save, you earn interest, and the government wants a cut of that because that's part of your income. So that's one of these parts we haven't uncovered yet. So I think what Rachel's coming at is there's maybe more incentive, and let me put your words down first. More incentive to be thrifty, potentially, with consumption. And one of the reasons you might be doing that is so that you can save more, right? So more incentive to be thrifty with consumption. And trying to increase saving. Because there is no tax. There is no, and let me be more careful here, there is no income tax on interest. Interest income. Put down all the words here so hopefully it starts to make sense. So for example, the little example we said, if you save $100 at 10% interest, that gives you interest income of $10. If you're in the 20% income tax bracket, you'd really only realize $8 of that $10 you made. But now you're going to get to keep the whole 10 because there's no income tax. So we have incentive to save versus consume. This might be one of the most important implications of changing this thing around. To stay on that line of thought, what did we learn in chapter 7, the capital market, the loanable funds market? What did we learn if people save more? What does that saving ultimately turn into? Loans that go towards what type of activities? Investment. Tractors, buildings, machinery. In other words, capital. Productive capital. And with productive capital, what happens to the production possibilities frontier? If there's an increase in capital, it shifts out. Economic growth. These were the underpinnings of economic growth that we learned from chapter 6. Where does growth come from? It comes from the accumulation of capital, physical capital being one, the other being human capital. Investments in education and other things, learning by doing, other sorts of skills that increase human capital. So that's an important bullet to put under here. So an increase in savings leads to, or is equivalent to really an increase in investment. Let me just even put an equal sign there. And so this is more machines, buildings, tractors we've mentioned. So more physical capital. In other words, we fundamentally changed our capital bucket. We're dumping more money indirectly by the incentive system that we've created by getting rid of the income tax and shifting people to giving them a little more incentive to be a saver rather than a consumer. Okay, other implications, yeah. Okay, so the question was, wouldn't the aggregate demand shift because of the consumption effect, right? Less consumption. It's kind of the bucket of water in the pool effect. So we went through that slide of whether we can buy a pizza or we can buy a tractor. And so if I consume $100 less and save $100 more, that money never leaves the system, right? It just gets spent in a different way. So as we cut back our consumption and start to buy more tractors, John Deere still has that money. So instead of Applebee's having the money from a beer and a hamburger and fries, John Deere's got the money. They pay their employees. It all funnels through the system. Or Applebee's gets the money. It all funnels with the system. And what the key is what are we left with next time period? Next time period, we're left with a tractor that's probably going to last another 20 years at least. Right? So there's persistence of the physical capital as we move through time, whereas the hamburger, fries, and beer got pooped out a long time ago, probably within 3 to 4 days after being consumed, right? It just is gone. It just vanishes from our island. So if we can set up a system that keeps capital on the island in a larger fraction than consumption, we're onto something in terms of the key ingredients to economic growth. Okay, other questions or comments and implications? Darren.
I just have to think of, when I was like on the website or whatever, it said that the price of goods would go down, but I don't really understand how the tax is going to make it.
That's probably, well, we're going to get into that kind of next lecture. I think you'd be able to dig into that subtopic and come up if you wanted to use that as a topic for your paper. There's a price effect. Again, this is kind of more of a subtopic. I'm going to say a little bit, but I'm not going to say a lot because I could probably spend a lot of time going on it. But it allows us to compete internationally because businesses don't have to build in that tax into their price.
Right. It said like imports and like exports don't get taxed.
Yes. Right. And so it allows the United, this is one of the other exciting subtopics, is that it allows the United States to be more competitive, which then also allows jobs to be kept in the United States potentially instead of going out too. So one of the reasons American things are priced high is there's a whole bunch of taxes that you guys aren't even aware of that are embodied in the price of the good. So when Pepsi goes to price the Mountain Dew, what's embodied in here is a bunch of payroll taxes and employee taxes, and sometimes there's excise taxes. There's a bunch of taxes that are into that $1.75 that you paid for this drink. If we eliminate all those taxes, just that effect all by itself drops it to maybe $1.50 or something. So that's really the price effect of how many taxes are embodied in the goods all by themselves.
So what you're saying is we're getting rid of, if not all, but most of the corporate taxes.
Yes. All taxes, all income tax. The only tax we're going to collect is that cash register, the 23% at the register. And so from an international trade effect, domestic American consumers will take that $123 into effect when they do it. But if we export our goods, they're exported at a cost of $100 for the company. So that's that downward pressure on the prices.
I just had a question about what would happen to people that work in the business of taxes currently, like tax attorneys, tax preparers, all that type of business.
They would lose their job. Yes. And in a great way, I thought about this a long time. My former business partner was an accountant, highly trained CPA. I mean, really knew taxes inside and out. I mean, the tax code is, this thick. I mean, nobody can even get all of that off the top of their head. So, extremely skilled guy, and people like him can spend whole careers just trying to find loopholes and edges and how we should organize our tax activities. Now, if we killed the tax code and we killed that job, and that person became unemployed, how long would they stay unemployed as a skilled attorney that kind of knows business and knows numbers? Do you think that they'd find another job in a productive activity? You bet they would, really fast. So the accountants would now all of a sudden start doing accounting on, the accounting business would not disappear. This will not put accountants out of business. And here's one of the main reasons why. When businesses go out for these business loans to increase capital, the bank has to know that they're solvent and that they're doing business right and how much money they're making, because they want to make sure that they're going to pay their loan back, right? So all of the accounting activities would still remain, except for those that are exclusively related to the tax code. Okay, Sarah?
But then if people start saving more money instead of spending more,
Yep.
won't it affect how much the government's taking in as taxes, and then they're not gonna make as much as what they're thinking they are, because people are gonna think, oh, if I'm getting all this extra, if I'm gonna have to spend all this extra money when I'm going to the store, then I'm gonna buy less, which means that they're gonna get less money, which means it's gonna be ineffective.
Good question. So the kickback to that is what Taylor suggested. And so if we have more people with incentive to work and we end up having more stuff out there, there'll be a quantity effect that'll offset that as we start to have more economic growth. So there's kind of two things going on in that environment, and this positive effect on productivity and the incentive to work is a big one. So that's kind of the indirect way. That would be a good subtopic as well. Rachel.
I don't know. I'm thinking about, what about people who are like unemployed or working out the government, because they don't really have much of a wage, but their consumption tax is still really high. They still be able to pay survival.
Okay, now you're touching on the really big elephant in the room. So, not only unemployed, but how about people that are not at a very high-paying job, right? What if you're making only $30,000 a year? You go to the cash register with your $30,000, and you get a 23% tax. The lowest income people have been made much worse off. Now, we haven't defined this yet, but that's called a progressive or regressive tax. So when we look at a person making $100,000 a year, if they spend all their income at the cash register, then they paid $23,000 of tax. They paid 23%, right? If we take the person who's making $30,000, that tax that they're paying at the register represents a lot higher fraction of their income. And so we call it a regressive tax. Lower income people are paying proportionately more than higher income people. And that's a major element to this that we need to think about. Here's how that's addressed. Everyone who has a Social Security number, that's an American citizen, is going to get a check from the government every single month. And what that check represents is a prepayment of the tax that you're going to face. Okay, so if you take a look at your handout, in 2013, for a family of 4, the current poverty level of income as defined by the government is $31,000 a year. So those people are going to get a check. If you look on the second part, page 2, the little box over here, and you go to a family of 4, so we've got 2 children, we get a let's see, we got 2, there it is, 31, so it's off to the right-hand side. They're going to get an annual check for $7,135. Every month, that family's going to get a check for $595. Whether they are Warren Buffett or the poorest of the poor. As long as you've got a Social Security number, you're going to get a check every month for $595. Go back to this table then. What that means is that you've effectively paid 0 tax if you make $31,000. It balances it out. So you're getting fronted, so to speak, the 23% tax, so that in terms of spendable income, you've actually got 31 plus the 7 that the government gave you. You've got about 37,000 to go to the store with, effectively covering all of your sales tax for that level of income. As you move down, look at what happens to the tax rate, the effective tax rate. If you currently make $46,530, you're going to still get, and you're that same family of 4, remember, you're still going to get the $7,000. Now you've effectively paid 7.7% income tax, if you will, because we're using the income now to kind of backdoor how much you're effectively paying based on your income. If you make $62,000, 11%, $124,000, 17%, $248,000, 20%. Now let me pause there for a second. Does $248,000 cover most of the United States population in terms of household income? It does. $248,000 is a pretty high income. I'm sure if we surveyed most of you on what your parents make, it's probably somewhere around there. If we went up one more, we'd probably certainly be covering most of you. So notice that for the middle income families or whatever, we're probably running around 20% effective income tax. Now, if you're Tiger Woods making $10 million a year, and he's probably making more, I just made that number up, he's going to be paying, of course, nearly 23%, right? So you start to approach that upper bound once you reach that point. That is what we call a progressive income tax. The poor pay less than the rich. And so we have this upward slope to the amount of the percent of tax that's going on based on your income. So that's how we inject the progressivity of the tax so that the poor pay proportionately less. Now, let me pause there. I see a couple hands have gone up. So let me add that bullet though first. So let me start off with, what do you mean this is a fair tax? That's not fair. The poor and rich pay 23%. That's not the American way. We haven't done that almost ever. And by the way, this highlights a super important point too. People get confused, and I think they made a strategic error in this plan, even calling it the fair tax. It sounds kind of nice, but it's too close to another, I don't even want to call it a brother, but another alternative called a flat tax. The flat tax would look like this with no changes. What makes this the fair tax is the part we just discussed, that it maintains that the rich pay less or the rich pay more and the poor pay less. So I really think they made a strategic error in the naming of this thing, because even after I talk to people about it, they come back and say, oh yeah, Russ, you like that flat tax. And I'm like, no, I don't like the flat tax. The flat tax, I'm not a believer in that. You'll talk to some right-wing people or conservative people that think a flat tax is the way, but I don't believe in that at all. I think that this part of it is a critical part for us in more than one way. So the answer to this is the prebate. And everyone, all USA citizens get a check every month. that covers 100% of tax due at the poverty level consumption. Before I go to questions, I wanted to point out this other bar. If you only make $15,000 a year, you're still getting that full $7,000 check. So it's actually a negative tax. You're being given money above. There's not only no tax, but you're getting money above that, getting a subsidy. Okay, I saw a few hands up. Anybody still remember their question? Darren?
So it's like basically for people that only make that like 31,000 or whatever. So basically that's like the people that would be on welfare normally, like they get like a food stamps and stuff like that.
Potentially, not necessarily. I mean, people can scrap by, but you got to be really, really frugal to scrap by a family of 4 at 31,000. But there are people that do, and they're not on any sort of assistance. So it's possible, but difficult. And they might rely on other programs, their local church or something else, and other family members maybe, who knows.
So what does that do to their incentive to maybe try and find a better job or better stuff?
Okay, great question. Let's add that as an extra bullet here. So, incentive for poor to work. Now, I think that question comes about because our current system, you've heard in the media that we give people money, we put them on welfare, and they're caught in the welfare trap, right? That they never can. Why are they caught in the welfare trap? Because if they work and make money, what happens to their welfare check? It goes down, creating a disincentive to work. Now, they're getting this money, but so is Warren Buffett. Everybody gets the money. Everybody has equal opportunity. If they go out and make $2,000 because they pick up a couple side jobs, they make $2,000. They still get their money, right? They go out and make $15,000, $30,000. In other words, there's no disincentive whatsoever. There's no welfare trap with this system. There's incentive for them to go out and work.
So are you getting rid of the welfare system as well by not getting rid of the G again?
No, not really, because all that welfare system's on the G part, right?
Right.
So if we look at the T minus G, I'm holding tax collections the same, and then I'm going to let the politicians, just like they've done for the last 200 years, battle it out on what G should be spent on.
Okay.
And so that could go in different forms of additional funds beyond this amount, for instance. But we wouldn't be caught in that welfare trap. So if these people were also getting food stamps or something else, those programs can still stay in place. That's, again, a huge part of this is that G stays the same. Government spending can be what it's going to be, and the politicians can fight it out. The only thing we're changing is how we collect the tax. Collect it at the cash register instead of collecting it based on income. Okay, so incentive for the poor to work. Yes. No income tax. And doesn't kick them out from getting the prebate. Now I say it that way because I hadn't really thought about that before too much until John said that. It could be that those programs, if they were getting additional ones, those could still possibly be tied to income somehow. But they would never lose their prebate check, the $7,000 that they're getting.
Are there any countries that have something set up like this?
No, there are countries that operate purely on sales tax, though, but it turns out to be more flat. And the reason most of those countries do is because when the government asks them to pay an income tax, they give them the bird. And they just say, Americans are kind of funny that way. We've been willing to pay income tax, like, oh yeah, okay, I understand, yeah, we figure it out and say, we just say, here, government. In other countries, they just say, screw you, And so the only way that the government can collect tax is by doing it at the cash register. So the Bahamas comes to mind as one, and there's some other places that have to collect tax at the cash register. And then of course there's more corrupt governments that collect tax in dirtier ways than, you know, things that are below board rather than above board in the corrupt system. All right, so what else? I saw some other hands here.
What if states raise their taxes, tax rates?
Okay.
Compensate, like California.
Yep.
They're bankrupt. What if they kind of raise the taxes? How would that affect?
So it wouldn't be much different potentially than what goes on right now. And so if California's charging, and I was just in California, it's beautiful, but if California starts charging 20%, and maybe this is a bad example, but Kansas is at 0, or Kansas is at 1%, eventually they can keep raising that tax rate to where I start scratching my head and I say, you know what, I can fly to California and visit about 150 days out of the 365 days a year. I could take a plane every day and live in Kansas and go to California. So the mobility of people would drive states to compete with each other on the tax rate. And that's kind of what goes on today. Kansas has been on a movement to try to eliminate the state income tax, and in hopes that that would attract businesses and attract people to Kansas. So maybe they'd move from Missouri to Kansas. Tennessee, Texas, Florida, South Dakota. There's many states that have 0 state income tax. And they end up having people flock to their states because of that.
You still wouldn't be able to have your whole paycheck because you still have taxes.
If you have a state that has an income tax. If they chose to maintain that, yes. But I think it'd be unlikely for them to do that. But yeah, if they did, then it would. Okay.
Can you explain what these percentages at the top of the bars are again?
So it's helpful to look at the 0% first. So if you're making $31,000, your effective tax rate is 0 because the government paid all of your 23%. If you make $496,000, the government paid you the 7% or the same amount, $7,000 or whatever, but then you went and spent the money and absorbed the tax.
So then you have to cover the remaining.
Right. You cover it at the cash register when you go to spend your money. Okay. So effectively, that's your overall tax rate.
And so that check lowers it down to that.
Yeah, and that's why it approaches 23% as we get close to it. Okay, now nobody's touched on this one yet, which kind of surprises me. I'll just kind of re-emphasize myself here. All USA citizens get a check every month that covers 100% of their tax due. So what's another implication of this? Immigration or illegal immigrants that are here working. We love them. They do a lot of stuff for the United States. We're under immigration reform right now. But they end up paying tax, right? Why? Because they go to the Walmart and buy toilet paper too, just like we all do. So now, when they get their paycheck, if they weren't paying tax, by the way, which could be happening, by the way, they can voluntarily choose to pay some tax too. They already had $1,000, but now they're paying tax just like everybody else at the cash register, except they're not getting the prebate. So an illegal immigrant worker that doesn't have Social Security as a verified American citizen, they're going to have their $30,000 worth of income, let's say, and the American is at 0% because of the prebate. They're actually paying $7,000 at the cash register, giving them an effective after-tax income of $23,000. Right?
Isn't that just kind of a consequence of them being here illegally?
Well, yeah, no, I think that money is going towards public goods and being in America. No, that's right. And a lot of illegal immigrants do pay. It's kind of a bizarre thing, and you guys might not have known this, but as an illegal immigrant, you can register voluntarily to pay income tax. If you kind of have a guilty conscience and you're like, I'd like to stay here, I'd like to pay, you can actually register and get a tax ID number and pay whatever share. And there are people that do that. Those are the people that are going to be at the front of the line, by the way, because they can be identified. They'll be at the front of the line if and when there's immigration reform. And so they'll be probably the first ones to get in the door if there's somebody that has been acting like that.
So,
All right, so that's, oh, go ahead.
sorry, so that sort of increases the incentive.
Well, no. So Rianne said, does that increase incentive? Because you're absolutely right. I want to pay attention to incentives. Does that increase incentive to be here illegally?
No, legally.
Oh, legally, yes, yes.
Okay.
Yep, you're right. So if we look at that illegal immigrant, the attractiveness of coming to America all of a sudden went down because you're going to be faced with that compared to the current system where you're paying the 9% here in Kansas. I saw another hand up. Let me go to Mallory.
So Social Security and like you have to pay property tax on your house or car and anything, you don't have to pay that at all anymore?
Those are state and county run things, so those would probably stay in place or could be adjusted through a state tax. But those wouldn't necessarily have to change. Yeah, those end up being kind of local. Let me put down that bullet about the illegal immigrants pay tax now. Because and they always pay tax when they go to the cash register, but now they're paying for the federal related tax as well. So it's really the federal tax collected at the register. Okay, Taylor, you got something else?
Yeah, so say this goes into effect, what's the chance of the tax rate changing, like, in a year's time? Like, if they put it in effect and they're like, oh, 23% is not enough, like, getting a huge deficit in the government,
Yeah.
do they just keep increasing it?
It'd be possible. It'd be subject to adjustment, yes. And so that part of it, I don't think we're in any worse position. And actually, we're in a much better position because of the transparency. That tax code, again, is so complex. It's the biggest bird nest you can imagine. My tax return from having a number of business-related things is literally an inch thick. Literally, when you lay all the papers together, it's over an inch thick. And so eliminating all that gives transparency. So instead of, and this goes against the crony capitalism thing that I've brought up before, where you're playing favorites of, well, should we support wind energy, or should we support low E windows, or should we protect the farmers, right? Or should we do this, should we do that, by giving them tax credits or whatnot? Eliminated. Every person in the United States that needs to go buy something pays this tax. Now, as John pointed out, we could still subsidize those activities. That's a function of G. So that would still go on, but it would be more transparent, easier to see, not a complicated bird's nest of stuff. Let's see, I thought I saw Michael's hand back.
Yeah, I'm going back to the illegal immigration tax now. I'm trying to think, wouldn't there be an incentive for them to move to the places that have the higher state tax then to kind of compete?
Well, they'd go to the lower state tax. I mean, anybody has incentive, both illegals and American citizens would have incentive to go to the low state tax places, because then the most they pay is 23. So in Kansas, if Kansas maintained the 9%, then you'd be looking at 32% in Kansas.
Are they, so they're looking at completely putting it on sales and have no income tax regardless?
Yeah, completely on sales. Before I take another question, I want to point out one other thing. Ability to convert. This is there's a couple amazing features I need to talk about. This is one. What do we need to be able to do this? We need to be able to collect money at the cash register. That's already in place. So imagine we're not creating a new system, a new book, some new rules, new procedures. All businesses already do this if they're operating legally, right? On calculating the sales tax. So this is amazingly easy. Ability to convert is easy. Businesses already do it. And for that matter, consumers already do it. They're used to going to the cash register. You know that it's going to cost more when you go to the money. You got to pull out the $123 instead of the $100. I mean, we kind of got that. This relates back a little bit to the loss of jobs of accountants. It was estimated that there are, and I kind of want to get this number right, they estimate 6 billion hours. 6 billion hours go into tax-related work every year in the United States. Currently. And probably higher now that we've got more. The more we add regulations and rules and change things, the more it gets. But they estimate that 6 billion hours of time gets spent on income tax related work. The accountants, the lawyers, whatever. Imagine if we freed up those hours and allowed them to do something else more productive. Just that aspect alone could make the economy head in some different directions. That's $265 billion for people for tax filings. $265 billion of money spent on income tax work. If all of a sudden we didn't have to pay that money again goes towards buying a tractor, buying new machines, doing whatever. An amazing amount of resources are freed up that are currently tied up in tax-related activities. Let's call it a day there. I'll be happy to talk to any of you